Right now, deep inside the biggest global banks, a totally new kind of employee is clocking in. It never sleeps, it never takes a lunch break, and it can independently settle multi-million-dollar trades or freeze a suspicious account in mere milliseconds. The systems running modern institutional wealth are becoming flawlessly AI optimized. But here's the incredible contrast. While banks are deploying cutting-edge artificial intelligence to protect every single penny, everyday individuals, people with great salaries, are completely draining their wallets through entirely preventable manual financial mistakes. Welcome to this explainer, where we're going to bridge that massive gap.
Okay, let's dive into this. On our agenda today, AI agents running modern banks, catching crime at machine speed, the human financial disconnect, building your safety net, escaping the debt cycle, and optimizing your wealth growth. Let's kick things off with Section 1, AI agents running modern banks. Or, as I like to call it, when software stops assisting and actually starts acting. So back in 2026, banking AI quietly crossed a major line. For years, AI in banking basically just meant chatbots, right? You ask a question, it spits out an answer. But a human still has to do the actual work. Well, Agentic AI is an entirely different beast. You give an agent a goal, and it formulates a plan, pulls the data, checks the rules, and takes multiple actions end-to-end to get a result. It doesn't just tap a human banker on the shoulder to point out a suspicious transfer. It literally investigates it, gathers the evidence, and resolves the whole thing as an independent actor. It's wild.
To really grasp why this is absolutely critical, we have to talk about the settlement countdown. When you buy a stock, that trade doesn't just magically finalize instantly. Securities and cash have to move and match up perfectly. And right now, the US, the UK, and Europe are all operating on a highly compressed one-day settlement window. We call this T+1. What this means in practice is that every single mismatched account number or any tiny settlement error has to be caught and fixed in a matter of hours. Manual human review simply isn't fast enough anymore, making these AI agents absolute essentials for institutional survival.
Take the Depository Trust and Clearing Corporation, for example. They're essentially the absolute backbone of U.S. post-trade infrastructure, and they are embracing this head-on. Their CIO actually noted that they're maturing into an AI-driven enterprise. They're using these agents to watch thousands of trades in real time, which is shifting the entire industry from just reacting to failed trades after they happen to predicting and preventing them before that T+1 clock even runs out.
Moving on to Section 2, catching crime at machine speed, the financial immune system. Think about it this way. If trade settlement is the plumbing of banking, compliance is its immune system. And this is exactly where Agentic AI is moving the fastest. Historically, investigating anti-money laundering alerts could take a human investigator days of pulling records from half a dozen different systems. But now, there's a new financial crimes AI agent, partnered between Fintech giant FIS and Anthropic, and already piloted by institutions like BMO and Amalgamated Bank. And it changes everything. It automatically assembles the evidence and literally compresses days of manual investigation down to just minutes, handing only the absolute highest risk, fully verified cases over to humans. But, who is watching the watchers here? Well, regulators on both sides of the Atlantic aren't actually trying to ban this autonomous software, but they are absolutely forcing some strict guardrails. In the US, agencies like the Fed and the FDIC require banks to prove they have continuous monitoring and human override capabilities. Over in Europe, the EU AI Act classifies AI that makes creditworthiness decisions as high risk, though, interestingly enough, pure fraud detection generally isn't. The global regulatory consensus is crystal clear. Banks must have heavily tested, explainable models.
So, the crucial point is that letting autonomous software move money brings up some very uncomfortable questions. First up is explainability. I mean, if an AI chains together a dozen decisions in a matter of seconds, reconstructing exactly why it acted is a massive engineering challenge. Second is concentration risk. If every bank uses the same few AI vendors, a single bug could ripple across the whole industry all at once. And finally, accountability. If an AI wrongfully freezes your account, the bank is still legally on the hook, which is exactly why they are building these massive controlled guardrails. All right, let's pivot to Section 3, the human financial disconnect, bringing it back to your wallet. Now, let's bring this all back to your own wallet, because here is the hard reality. Global institutions are spending billions to perfect their financial systems, making absolutely sure not a single trade fails or a fraudulent penny escapes.
Yet, despite earning great salaries, roughly 90% of everyday individuals are basically failing at their personal finances. We are draining our own wealth through completely preventable, entirely manual mistakes.
Section 4. Building your safety net, the foundation of personal finance. Just like those big banks mandate strict risk controls before making a move, we have to build foundational safety nets before we even think about investing. There are 3 huge mistakes that will instantly destroy a personal financial foundation. Mistake number 1, not having a liquid emergency fund covering 3 to 6 months of expenses. Listen, an emergency fund is not a stock market investment. It's a liquid safety net designed to stop you from taking on high-interest debt when life inevitably happens. Another massive error, mistake 3 on our overall list, is mixing insurance with investments, like buying those endowment policies. You should never mix the two. Buy term insurance for high cover at a low premium and invest your money completely separately. And a third critical foundational mistake is relying purely on your company's health insurance. If you lose your job, you lose your cover right along with it. Personal health insurance is a non-negotiable expense, not a luxury. Section 5. Escaping the debt cycle. Stop funding your own liabilities. You know, banks know exactly how to manage leverage intelligently to build value. Humans, well, we often borrow money for the absolute worst reasons. Which brings us to mistake 6, taking out personal loans for liabilities. Look, debt isn't inherently evil if it's value building. Think a home loan or an education loan that increases your future net worth. But taking high-interest personal loans for depreciating assets, like a new phone, a flashy bike, or a lavish wedding just to impress people you don't even really like, that throws you straight into a vicious debt trap. The simple rule to live by here is, if you don't have the cash for a depreciating liability, you probably shouldn't be buying it in the first place. And this brilliantly illustrates mistake number 7, which is arguably the most dangerous trap of them all. When you choose to pay only the minimum due on your credit card, that remaining balance doesn't just sit there patiently. It gets hit with an absolutely insane annual interest rate of 36 to 42%. It's literally the most expensive loan you can possibly take. You have got to always pay the full bill on time every single time, or that compounding interest will just eat your wealth alive. Section 6. Optimizing your wealth growth. Defeating inflation and risk. Okay, so let's say you've built your safety net and avoided bad debt. You still have to actually grow what you save. And that brings us to mistake number 2, keeping all your extra cash in a standard savings account just because it feels safe. But the math here is brutal. If your savings account is yielding, say, 3 to 4%, but the inflation rate is sitting at 6%, your money is literally losing its real purchasing power every single year. So beyond your liquid emergency fund, your money actually needs to be in growth instruments if you want to defeat inflation. Let's move to and see how this builds into our final wealth killers. Mistake 5 is following blind tips on really complex, high-risk derivatives, like futures and options, without doing any basic research. The harsh reality, most retail traders just lose their shirts here. Mistake 8 is a total lack of diversification. Putting all your eggs in one basket by dumping everything into just real estate or just gold, instead of spreading out your risk. Then there's mistake 9, delaying your retirement planning past age 25. Waiting until your 30s means you're missing out on massive compounding benefits. And finally, mistake 10, unchecked lifestyle inflation. This one really sneaks up on you. As your salary grows, your expenses for bigger homes and better phones grow right alongside it, keeping your actual saving rate completely flat. We started this explainer by looking at how modern banking is deploying these totally tireless AI agents to monitor, predict, and protect institutional money down to the very last fraction of a cent. They literally leave nothing to chance. So I'll leave you with this final thought. In a world where flawless autonomous systems never sleep in order to guard institutional wealth, isn't it time you applied that exact same rigorous standard to your own wallet? Stop making these preventable mistakes, build that safety net, and start actually optimizing your wealth.